Triveni Turbine, though, up 9% as we speak. Speak of result reactions, and there is one reaction you got to watch out for. But take a moment to thank both Kunal and Nirav for joining in today and giving us their thoughts. Really appreciate your time. A quick conversation with Anil Yadav, Director of IRB Infra, who's joining in right now. Toll collections for the month of October were very strong. Mr. Yadav, good having you. Thanks for joining in. What's led to this 21% uptick in toll collections? Is it the festive month, and will that even off, or do you reckon that can continue?
I think this year we have seen extended rain in the October as well. Probably the growth will be in the coming months should be better. We have added assets also that has given an overall increase of 21%. And the number for November and coming months onward, the number should be better than what we have delivered in the October.
The expenditure numbers analyzed carefully suggest that the government capex on road as well has been slow thus far. Do you anticipate a pickup, or is it difficult to say that right now, Mr. Yadav? On road construction specifically.
Yeah. With respect to government capex, large award comes from the NHAI. And if you look at the various past years, several past years, the most of the contract were awarded towards the fag end of the financial year. And we believe that considering the large pipeline, there are TOT and BOT project which is lined up in the month of November and December as well. And there will be much more project which will be coming towards the fag end of the financial year. And typically, in terms of award towards the end of the financial year, there are many projects are budgeted up. We believe that there will be an award towards the end of this financial year.
Awarding towards the end of the financial year. Okay, so bunched up. Would you reckon that momentum activity could continue into Q4 as well? Effectively, what I'm trying to get to, Mr. Yadav, is this: that there are views divided upon whether some people hope that capex will pick up and some people believe that it will not. From what you are telling me, that if it gets bunched up in the last month, and if it spills over, then that's a clear sign of awarding as well as government capex. You believe that will happen?
Yeah, we believe that that will happen. For road sector specifically, the government is putting more emphasis on PPP model. That's why we are seeing that there are more thrust on the BOT and TOT project. And the BOT and TOT project are in fact lined up in the month of November and December as well. And towards the fag end of the year, the number of awards should increase. And we believe that there will be a sufficient award by end of this financial year.
Right. Thank you very much, Mr. Yadav. Great talking to you and sharing perspective on those toll numbers for IRB Infra. Let's take a look at how the stock is doing in early minutes of trade. Usually reacts to news flow, especially when it comes to toll numbers. But we're at the fag end of the earnings season, and it's been a mixed bag from what we understand. Venkatesh Balasubramaniam of JM Financial joins in. Venkatesh, good morning. Thank you for joining us. Largely expected, it's been a mixed quarter. While you have had a handful of companies that have outperformed street expectations, the broader theme really has been some disappointment. While you review this for me at a more macro level, tell me on what parameter has the disappointment come and on what parameter you've been impressed. So are you impressed with companies that have reported improved operational efficiency? Margins, I understand, for consumption names is under pressure because of commodity inflation. Volumes also declining for, say, consumption, but of course doing okay for companies like a Hindalco. So wrap it up for us before we break it down sector-wise and company-wise.
Okay. See, we have analyzed close to almost 160 companies in our coverage universe. We have like almost as a house, JM covers around 275 companies. We've looked at numbers of almost 160 companies. And what we have observed is almost 44% of the companies have missed expectations. Now, this miss has been much higher than what it has been in the past so many quarters. So clearly, the results are disappointing. What we are less worried about things like margins at this point in time. We are more worried about, is there a problem with the top line growth? And what we have discovered is almost 27% of the companies have missed their top line growth expectations. More specifically, if we dig down or drill down a little deeper, what we observe is the fact that if you see sectors like FMCG, retail, mall operators, and even autos, there is an urban slowdown. Now, this kind of worries us in the second quarter, but we also believe that there is a silver lining in these slightly dark clouds, because while we believe urban demand is slowing down, we also observe that there is a pickup in rural demand, because our own data suggests that since August onwards, rural wages have started going up. So rural demand could go up. Similarly, even if in this auto related slowdown, if you particularly look at two-wheelers, you will see that two-wheelers have started doing well from the month of September. Uh, Interestingly, in the month of October, even four-wheelers at the mass end of the market has started doing well. So we believe this slowdown could be more cyclical in nature, and you could potentially see a rebound in the economy and a rebound in numbers of companies towards the end of December and maybe early January.
Venkatesh, good morning. Neeraj here. So, if you view this, I'm presuming that you're viewing this as a glass half full this quarter too. Does it fill up a little bit in quarter three based on the management commentary that you've heard thus far? Do you believe the challenges persist in quarter three, or would the festive season plus the year end, etc., maybe travel, etc., take care of some of those issues? Any thoughts on that before we get to specific sectors?
Yeah, I would tend more towards the positive side of things, because I believe a lot of people, when you do macro analysis, you generally tend to forget to look at a lot of bottoms up things which are happening. Now, monsoons in the second quarter have been excessive. And when monsoons are excessive, what happens? It disrupts a lot of things. It disrupts mining activities in the country. It disrupts supply chain of a lot of companies. And I was just hearing your previous guest from IRB who said that how tolls have started picking up in the month of November. So October and November. So I take a lot of confidence from these factors that it was more of a cyclical kind of a slowdown which happened in the second quarter. There are other aspects also which gives us this kind of confidence. We are observing a few other macro factors also. Now, even look at, let's say, government spends on capex. Government's capex spends in the first 6 months of the year has been much lower than what it has been in the past few years. And we don't believe there is a problem with government balance sheets or anything like that. So we believe that capex could rebound in the second half, and that will percolate throughout the economy, and we should see maybe not a strong rebound, but like you said, the glass will start filling up in the third quarter gradually, and we should see it filling up even more in the fourth quarter.
Sure, let's break this down. And I think you seem pretty impressed with what PSU banks have done. It's interesting because I think the market was getting very excited about some of the reportings that came from private sector banks. What stood out for you with PSU banks, and looking into the second half of the year, any concerns that stand out, or do you feel the going will be good despite an increase in credit costs, despite the fact that they are struggling to bring in deposits? What makes you constructive, and if yes, any standout banks to buy?
So on the PSU bank side, what we have observed so far in the year is the fact that almost close to 67% of the PSU banks who have reported, they have beaten our number expectations. So that makes us positive. We also believe that Trump coming into power also implies that globally interest rates could be higher. And even in India, RBI could take its own sweet time in terms of cutting rates. Now, if that happens, on a relative basis, we would be better off with the PSU banks because valuations look relatively better compared to the other sectors. And we believe that a place like, maybe the NBFCs won't do that well in a higher rate kind of an environment. And that is why we are suggesting that you might be better off with the PSU banks. And stock specific comments I would desist from making.
Okay, fair call. No problem, Venkatesh. I'm just trying to gauge your investor or coverage universe, if you will. But let me try and nail it down to one or two sectors that are a bit perplexing. Now, consumption by and large, or at least staples by and large, seem to have an iffy month, save for maybe, I mean, even Britannia numbers seem to be off the charts completely, save for the fact that their volume growth numbers looked okay. But QSRs selectively like Jubilant, etc., have done okay. Now, when you look at pure play consumption, staples plus QSRs, I'm not including premiumization out here, or premium consumption like ethos or cars, etc. What is your thesis? I mean, are these companies' commentary or results giving you any confidence, or is it a sector to avoid?
I think for the time being, we would not get too excited about consumption as a sector. We would be more consumption, specifically the old economy kind of consumption. Whereas if it is consumption related to internet related kind of companies, we would definitely be positive. But the older economy, definitely there are some issues. So we would possibly avoid those sectors.
The other thing is, what has been to your mind, in terms of both the reportage and the commentary, the worst possible outcome that you've seen in this quarter, which would make you believe that unless things significantly change, you would want to stay underweight? Is it consumption only, or is it something else?
I think it is more related to consumption. See, because we usually worry more about top line growth than margins. See, margins are a function of raw material costs, and raw material costs go up and down. Now, that if, for example, in a particular quarter, your input costs are on the higher side, it is possible that in 6 months' time, that can reverse very dramatically. But whereas if top line growth itself is slowing, we would worry. Now, at this point in time, we are not very panicky about it, because we believe that second quarter had some very specific issues. I mentioned one thing about monsoons. There have been other factors. For example, some of the commodity-led sectors, there was a sharp fall in commodity prices in the month of August and September, which caused destocking at the dealer level, on the dealer level side. And because of that, top line growth of quite a few companies on this side have been slower than expected. Just to give you an example, for example, plastic pipes as a sector has faced this problem. Wires particularly has faced a problem in India. Now, a lot of these things will reverse in the coming quarter. So while it was worrisome, we will be monitoring top line growth a little more closely than we would worry about margins.
All right, Venkatesh, what I want to talk to you about is, now let's look ahead, right? Because the earnings are now behind us. What's more important is what happens in the second half of this financial year. Which sectors do you expect to be most affected by raw material inflation and supply chain issues going forward? Because that was a clear trend we picked up in a number of companies that are in fact impacted by commodity inflation.
So I think those companies where we have had those raw material issues, that should continue in the second half. I don't think that is meaningfully changing. It's not like the sectors which face the raw material issues that will have that is going to reverse. Those should continue in the second half.
Also, just sticking with looking ahead, could you clarify the impact of BIS related cost on consumer durables, and if there are any of these companies that might be able to mitigate, or subsectors that might be able to mitigate these pressures going into the second half?
Yeah, so specifically where we have seen this BIS related issues, we have seen it in, for example, consumer durable companies, for example, on the AC side. Interestingly, while numbers were a little lesser than what we had expected, we still saw almost like 20-25% growth, which basically means demand for things like consumer durables are still decent, at least on the AC side. So you will see cost pass-throughs happening, and hopefully these will get resolved over the next 6 to 9 months.
Venkatesh, given the mixed results across sectors, which sectors or companies do you believe offer the best risk-reward balance for investors right now?
Okay, at this point in time, we like metals, we like internet, we like auto ancillaries, we like asset management companies. On the financial side, we like PSU banks relatively more. IT services should do well next year if Trump actually goes ahead with those tax cuts, because that will be very good for the US economy. While there is a fear that the H-1B visa issues would once again rear its head, like in the first term, our own analysis, our own IT analysts suggest that at this point in time, Indian companies have hired more local talent there, so it really wouldn't impact. Even if H-1B rejection rates go up, it will not really impact numbers or margins. So we are not as negative on IT services. We look we are more positive, relatively more positive on IT services if Trump actually goes through with those tax cuts.
One of the sectors on which a lot of people turned very constructive because of the oil price correction was oil marketing companies. Now the fear, of course, is a cut at the till, but that thus far we haven't quite seen, right, happening. So therefore my question is, if there is no change out there, do you foresee a quarter, at least the OND quarter, the October to December quarter, of strong earnings growth? Can that help the stocks perform? That's the other add-on question. BP, HP, IOC.
See, our in-house view is we are not very positive on these sectors.
Why so?
We have come off I mean, there has been GRM under recovery. There has been low GRMs and LPG under recovery. We still need to see if these issues will get resolved in the third quarter. So in-house, we do have a sell call on this particular subsector.
Okay. You don't believe earnings growth will come in because of lower oil prices and higher marketing margins?
See, we just need to see that. Let's wait for another month before we take a call on that.
Okay. So, and then the allied question therefore is oil upstream. Because of the oil prices coming off, do you reckon that those earnings could remain under pressure or could be under pressure, and therefore anybody wanting to bottom fish, is it a good idea, ONGC, oil, Reliance, etc., or kind of stay away from there too?
We would stay away from the oil and gas sector also.
Entirely. So upstream, downstream, you are away from that. You are away from city gas distribution as well, or is there an exception
Yes, even the city gas distribution companies.
Okay, okay. Avoid some oil and gas.
Lots of avoids. But Vishwanathan, Venkatesh, one more quick question. Real estate and hotels have showed some strong performance, and we are ahead of in the midst of the earnings season. What is the outlook for the third quarter for the sector? And just extending that conversation to building materials and EMS players. Now, they have clearly seen some sort of cost challenges. Do you see margin improvement in the second half, or the competitive dynamics actually going through a change?
Okay, now specifically on real estate, we remain extremely positive on real estate. We talked about urban demand slowdown, but we are not observing an urban demand slowdown in real estate. So we remain very, very constructive on the real estate sector towards the end of the year and going forward for the next year also. Now, specifically on building material, the dynamics are slightly different. I mean, if you break it down, you have plastic pipes, you have the tile companies, you have some of the other iron pipe companies. So their competitive dynamics are a problem. Just to give you an example, in plastic pipe companies, margins, EBITDA per ton is contracting from the highs of the COVID period. So what is happening in real estate, I don't think one should extrapolate because there is a lot of competition. Now, with Trump coming in, and if Trump actually puts in very high duties on China, that could be beneficial for some of the Indian tile companies, because then the Morbi cluster starts exporting more to the US, and that will put less pressure on growth and realization in the domestic sector. So, but all these things might take maybe 6 months, 9 months to play out. Over the shorter term, we would be cautious about the building materials sector, because even valuations are not very cheap. If you see across building materials, most stocks are trading maybe at 1.5 times or 2 times above mean in terms of standard deviations above the mean. So valuations are also not very, very supportive. We have had one round of corrections, and if these kind of earning misses continue, building materials will be a little cautious.
Cautious on building materials, that's the word coming in. Also, are there any emerging themes from this quarter's earnings, digital transformation, IT, sustainability, maybe in industrials, that investors should, maybe watch out for?
I personally believe that, I mean, investors should definitely look at exporters from India, which will benefit from duties on China. So there is a whole list of companies that you can evaluate. I think it is time to once again start looking at, for example, the chemical sector, which has been out of favor for the last 2 to 3 years. Because interestingly, what you will also notice that in the chemical sector is one of those sectors which actually saw FII inflows in the month of October, because valuations have come off. I think most of the earnings cuts have also happened in that particular sector. So I don't think there are chances of too much earnings misses. And if those duties actually come through on China, it will relatively favor India. The supply chains in chemicals were anyway already moving from China to India. I think it had seen some kind of a slowdown over the last 6 months to 1 year, because China came back in the chemical markets very, very strongly. But I think a part of that can once again reverse. So people should evaluate chemicals very, very constructively, is our view. Now, besides chemicals, I think even once again, wires and cables companies, they've had disappointing numbers in the second quarter. Numbers have got cut, valuations have become reasonable. I think people should look at that particular sector once again very closely. Again, an exporter who will benefit from the China plus one trade. And there are a few other China plus one sectors which one can again reevaluate.
Venkatesh, great talking to you. Thank you for that. Hopefully the second half of the year looks better for the larger part of India Inc. But for now, of course, on a sticky note. Well, thank you. Have a good day, and we'll hopefully see you soon again.
Thank you.